I'm no Nostradamus, so we talk to you guys where we see a little bit what's coming down the pipeline, and then we make adjustments and pivots accordingly. And like we're at least $1 million richer because of what you guys have said. It's like
awesome.
So, and that's just right now.
I'm hoping you're more than $1 million richer.
Oh, I'm just saying where we're at right now, 6 years in, like we're at least $1 million bigger and further and profitable.
Hi, I'm Paul Giannamore. I wanted to welcome our new subscribers to the channel. You know, historically, Potomac TV has been focused on business and operational information and interviews for residential and commercial services business owners. But after the publication of the Sell-Side M&A Masterclass last month, my LinkedIn inbox has been inundated with a variety of different requests. So Dylan and I will be sitting down filming more extensive M&A masterclasses, both focusing on the sell side as well as the buy side. I intend to talk about the choice of process, delving deep into M&A psychology, as well as extensive buy side practice, approach, and due diligence. For those of you who have not subscribed, you can click below and subscribe to the channel. Furthermore, we've provided a link here in the description where you can get on our email distribution list. And if you do that, you'll receive an email right in your inbox with our latest publications. Feel free to put a comment below on the types of things you want to see. I mean, this channel is largely driven by you, the viewer, and what you want to see from us. Again, thanks for joining us here at Potomac TV. All right, Nick, you're back on the show.
We're here. You know, a year after Hawaii, and been having a lot of great conversations with all the PCOs, the owners here out of Pest World. So it's been a lot of fun. How you holding up?
You know, this is kind of the morning after show, right?
It is
off to the airport here in about 45 minutes.
The tailored suits.
I have the DTs from the bar last night because I don't drink anymore, and now I did. But coming up. This is your show this morning. This is the Nick show. Let's see.
That's right.
I want to see. I want the audience to see what you can do. So what do you got planned for us?
So I thought it could be a good idea if we just kind of went through maybe some of the conversations, recapping what we've talked about with folks over this week.
Are you sure you want to recap what I talked about?
Yeah, I think that would actually be quite fascinating.
It would be fascinating. It had nothing to do with business all week. But
I mean, the one thing that I heard from a lot of owners, though, is that they heard Potomac is developing a technology that could actually allow the Mexican to wear subtitles across his chest, like streaming as he spoke. Is that true?
That is, that's aspirational. I'd love to. Yes. Look at Nick. The finance guy's got a couple of jokes out here this morning. I like it.
No, the other one that I did hear though too is they were wondering if Dylan's Testarossa is for sale at a certain price. Have you heard that?
I didn't hear that either. No, I did not. This is I'm not used to this, Nick. You having jokes. It's just like,
can we just talk about tax or something?
Fat Pat had a book of questions. You're gonna have a book of jokes. All right, give it to me.
But you know. One question that I did get a lot, and it's funny because we're, talk all the time. We talk about private equity, talk about investments, talk about the business, but people are looking at me and they're like, Nick, so like, what do you actually do?
That is a good question. Actually, tell us, what do you do?
So basically, I focus on the pest control industry, on helping owners save money on taxes and then maximize their returns on investments after the sale. Okay.
But is it saving money on taxes only when they sell, or can you save them money right now when they're not selling?
Yeah, it's a continuum. So it's really bifurcated among three different phases: pre-sale, during the sale, and then reducing ordinary income taxes after the sale. And so a lot of folks then assume that I'm a tax guy. And so I am a CPA, but I don't prepare taxes. Really, the focus is on investments. But I just find that it's much easier to define, millions of dollars of value when you're talking about taxes than it is to promise, investment returns that can be uncertain. And oftentimes, folks overpromise. So, So I got that question a lot. I hear you got the question a lot about that you always get, which is typically what's going on in the market.
Yeah, I mean, look, there was obviously always a lot of questions about what's going on in the M&A market. I mean, it's actually been particularly robust. Um, I would say, you know, well, look, we're currently working on 16 live transactions that are out in the market in various stages, which is greater than typical. I mean, the pipelines are particularly extended. Yeah, it's been a very robust time. Now, the strategics have been quiet.
What do you mean by that? The pipelines are
Well,
extended.
I guess there's a lot of backlog of deals waiting to go out into the market is probably a better way that I should have said it. I'm on like 4 hours of sleep this morning. So, yeah, I mean, there's a lot of activity. The strategics are still relatively slow. We see what's going on with Rentokil. They're acquiring, right? And I think they'll do their 250 million pounds in acquisition spend. They'll probably do a lot more of that in the rest of the world than they will in the U.S. Rollins has continued to do deals. Anti-CMEX has been relatively slow. The question is whether or not they'll be eyeing a public offering next year. But, the financial sponsors have stepped in. We're co-advisors with JP Morgan on the Aptiv deal that closed. What month are we in now? October? It closed on September 30th. So, that was a very large transaction for this industry. It was a multi-year process. We were originally engaged back in 2022. And so it was kind of an iterative process, but, that transaction finally closed on September 30th. That's great. David Royce, I think, will finally retire and go off and do something else. He said, I am out of Pest for good. And I actually think he'll be out of Pest for good this time. So super stoked for him. I think it was a great transaction for him. He's a great guy and has built a great business. So that's good. So that got done. And then there's a handful of financial sponsors that continue to enter the market. So again, M&A is dominated by PE now. Well, we're seeing it across the board.
Have you seen the strategics get any more competitive with private equity on valuation multiples or just be more involved in deal process?
Yes.
Targets?
Yes and no. I think it's pretty. I'll give you an example. We just closed a transaction. It was a PCT Top 100 company 2 weeks ago, and it was done by one of the strategics, and it was a case that I thought was going to be a PE deal. And one of the strategics, it hasn't been announced yet, so I can't say the name of the company, but one of the strategics really stepped up and got it done. So I think they are willing to bend returns and buy a business if it's really important for them. They are not competing on run-of-the-mill companies. Yeah, the strategics aren't going to really fight for something unless it's very interesting for them. So, we're seeing that. I would say that, multiples have been pretty constant this year from last year. So we had the big spike up into COVID. In 2021, it peaked. In 2022, it stayed elevated and started to fall. And then it's been pretty consistent since 2023.
Could you make the case that the strategics are being too conservative with their acquisition activity and the valuation multiples that they're willing to pay?
No, I think the strategics have done a lot of transactions from 2017 through 2021. And so if you look at Rentokil and you look at Anti-CMEX, those guys did a lot of deals. And I think there is, part of that value creation opportunity is integrating these things, rationalizing the business, harmonizing systems. So I think that's an important part of getting a return from a deal. And I think we've seen a period of digestion. I would argue that Anti-CMEX has attempted to do that in North America. I think they're still doing it. I think Rentokil obviously is busy digesting Terminix still and integrating some of their old portfolio companies, trying to think about branding. I think Rollins is probably in the best position of the three to do accretive add-on acquisitions. I think Rollins continues to focus on building their independent brands business. Jerry was part of the independent brand operation after he came in from Home Team. I think he'll continue to grow that. So I would argue that they're probably not being too conservative from a purchase price perspective. I would argue that they're probably being more conservative from a strategic perspective on this whole integration and how are we creating value from historical deals. Just these guys don't need to do deals like financial sponsors that want to get into the space. So they're like, if we're not going to get an adequate return, let somebody else buy it.
You look at Rollins' multiple though. Last I checked, EV to EBITDA north of 30, 35 possibly. They're picking up businesses anywhere from 10 to 12 times EBITDA. And if they're able to cut costs within those businesses, ramp up density, given their existing operations in those areas, to me, it seems like they could pay more and still have those be very accretive from an incremental return perspective. But
Yeah.
I get it. Like, why not be greedy in a sense of paying less, ramping those returns up even higher? But just a few of my thoughts on it.
Yeah, and I don't want to get too technical here, but as you well know, part of an acquisition decision historically comes down to accretion dilution analysis, right? Like, you're a publicly traded company. Is this deal immediately accretive or dilutive, or becomes accretive or dilutive over a short period of time? And I think that was I think that was a more important analysis 10 years ago or 15 years ago, when you had a huge disparity between, publicly traded multiples, and multiples on the whole were much lower.
True.
And now it's like, okay, well, I'm trading at 35 times. I can buy a business at 25 times and it's still accretive. But does it actually make sense on an internal rate of return basis? Sure, it's accretive, but I mean, what sort of returns am I getting? I'm going to get a 4% return. Do I really want to do that?
Not exciting. But how about 15 times, 16 times, right?
Yeah, and I think that's kind of where the market has pushed these things. And it looks like it's going to, I would say, we'll probably see another $600-700 million in acquisitions close in the next 180 days, I would say.
That's outstanding. I love it. So, as it relates to this market update, the one other question I'm curious about is that you've had a number now of big PE-backed roll-ups that have been operating for 5-6 years now. I'm thinking like Greenix, Anti-CMEX, Pesco, some of these others. And no one's really exited yet, those larger roll-up PE-backed companies. So I'm curious, do you expect some activity within that segment over the coming year, 2 years? A lot of people with rolled equity are curious.
Yeah, I mean, I would say every one of these companies that you mentioned is ready to go at any time. I would say, and this is just conjecture on my part. I mean, if somebody wanted to come in and pay 25 times for Pesco, I think we would see that transaction close. The reality is, some of these businesses are still in early innings with regard to integration. You take a company like Pesco, it's a couple years old. They bought a lot of disparate businesses across the United States. I think they still do have a lot of heavy lifting to do from an integration perspective. I think they've made massive strides. I think they've done a great job with that business thus far, but I think it's still in early innings for them. But I think every financial sponsor wants to sell that asset as soon as possible, for the most part, right? Yeah. If they can get it today, they're going to do it. I would say probably by the end of 25, you will see one or two or a few of those go.
Last question on the market, because you are on 4 hours of sleep.
Yes, I am.
Please email your questions in if you have other questions on the market. We can do them on 8 hours of
We
sleep.
can do them when we're awake.
Yeah. Any notable trends you're seeing in the door-to-door acquisition market, in a sense of companies that are primarily door-to-door businesses? Any comments on the acquisition market in that realm?
No, I mean, I see these deals still getting done. I think, it's interesting to me. Here's an interesting concept. I think we will likely see the big players out there actually start to do door-to-door themselves. I think we're going to see. I think you might see an Anti-CMEX do it. You might see Rollins ramp up and do this more. I mean, we could live in a world in the next couple of years where a company like Rollins is putting on 50 or 100 million in revenue per year on the doors. I think that could happen. To me, it's rather uncertain as to what that could potentially do from a multiple perspective with regard to acquisitions. But it's like, I think, here's the discussions I have with senior executives of these companies. They have seen transaction multiples go up across the board, even in door-to-door, right? I mean, back in those days, you'd pay 70 cents on the dollar. Now, like some of those deals will get done at, 12, 13, 14, 15 times EBITDA. And the question is, like, when those businesses are only 3 or 4 years old, there is some value in buying those seasons accounts, but you're not really buying a lot of capabilities. And so the question now comes down to, have we been thinking about this wrong? Should we go out and do door-to-door ourselves? And that creates some problems. It creates the problem of they're scared to death of bad reviews. I mean, they get bad reviews anyway, but they're scared to death of getting bad reviews from door knocking. That's number one. Number two, financial implications. When you sell a door-to-door account, it typically, historically, would run through your P&L. And it's a charge on the P&L. It's an expensive charge. And so you're a publicly traded company or a big private equity-backed company, you have to worry about earnings. And so that wasn't a good thing to do. And, companies like Rollins now, for example, they're capitalizing door-to-door expenses. So they will capitalize it over a very short duration, 2 years. With some of our clients, we'll capitalize it over 4 years. And what does that mean? That means, okay, I spend $100 on door-to-door today. I get that account. I'm going to put that on the balance sheet. And I'm going to expense it on my P&L over 4 years. So $25 a year, right?
Makes sense, yeah.
And, there's a lot of debate over how long to capitalize how long do you capitalize it over the life of the customer? If you do, how long is the life of the customer? Is it 2 years, 3 years, 4 years, 5 years? So I think, when we see the publicly traded companies now, they're capitalizing it 2 years. We might see them try to press for 3 or 4. We'll see what their auditors allow them to get away with. But the other aspect of that is like, okay, well, if I'm Rollins or I'm Rentokil, I can go out and buy a minority stake in a door-to-door business. And if I'm consolidating that minority interest, or I can find myself with a minority interest in a business, I don't have to consolidate that on my P&L. So what does that mean? That means, Nick, you own a door-to-door company. You're doing $100 million in revenue. I go out and I say, Nick, I'm going to buy 49% of your business. I'm going to have control of that business because there'll be a variety of different consent rights in the participation agreement. So in a lot of ways, I'm going to be able to control it. I'm going to have a call option on the rest of your equity at some point in the future. You may or may not have a put right, putting me at some point in the future.
Right.
But now I control a $100 million door-to-door business. Right? So it doesn't run through my P&L because it's not consolidated because I'm a minority owner. And now what I can do is aim door-to-door wherever the heck I want. I can run a ton of expenses through that. I don't have to worry about it. And it solves a lot of problems for me. I think that's probably going to happen. I would imagine, I remember sitting in Cairo years ago actually having this conversation with one of the CEOs of one of the publicly traded companies. I remember exactly where we were sitting, and we were talking about the use of, taking a minority interest in order to keep these charges off the P&L. So I just think the era is here now. I think we're seeing, if you think about it, take the big three. Anticimex, new CEO. Rentokil, at least Rentokil North America, brand new CEO. Rollins, Jerry, brand new. So I think these guys are going to be willing to do things that some of their predecessors haven't. So I think door-to-door is about to change. And I think that creates a lot of opportunity for smart guys out there. And I think that throws in some huge risk factors on the horizon for some of these players. So
that's pretty fascinating. It seems like a really interesting, compelling strategy for those that are, more income statement focused, particularly the public companies.
Yeah, because when I think about it, if I'm a publicly traded company and I could take a minority interest in a door-to-door business, then I can run all those charges through there. I don't have to worry about it going on my P&L. I can control density very easily. I can control greenfield operations.
And then you can buy it in as it matures, right?
That's
as
right.
Those optical metrics become more favorable on the income statement, you bring it in.
Yeah, you run it for 5 years, and then all of a sudden you call the rest of that equity, and then in 1 year maybe you're doing a $500 million deal at a predetermined price. Boom. And now you're consolidating it. And now all those earnings hit your P&L. So if somebody does it, it was hatched right here.
And it's going to need some structure and help.
Yes. What else you got on your on your list?
So the other question that I get asked a lot, especially for owners who are considering selling, is how do I replace my income, right? So you're taking money from your pest control operations as it throws off cash on an annual basis, and that's what you're living off of, right? It's a very different and foreign world for the pest control business owners to go from that business-based cash flow mindset to now more of a wealth-based mindset where they have $50 million. And while that's a lot of money, they need to figure out how to generate attractive after-tax cash flow distributions to them and their family. And so relating it to this private equity conversation that you and I have been having over a number of months, one thing we're doing at Essential Partners is we're investing in private loan funds for these folks that are selling their businesses. And so what's a private loan fund? So private loan funds are essentially funds that are managed by huge multi-hundred billion dollar money management firms. Might it be Blackstone, BlackRock, et cetera. I personally don't use those two, but people know those names. So what we do is we would give, let's say, a particular private loan manager $10 million to basically then steward to invest in private loans. Okay, so what's a private loan? So if a private equity firm is going to buy a $100 million pest control business, they're not going to take all of that $100 million from their private equity fund. What they do is they take around $60 million from the private equity fund, and then they go out and they borrow $40 million, okay? And the place that they borrow that $40 million from is these private loan funds or direct lending funds. So essentially, by investing in multiple private loan funds, you can build a portfolio of private equity-backed sponsor loans that yield around 10% right now.
Do those rates float?
So the loans that are being made to finance these private equity deals, these are variable rate interest payments. So what that means is that the Federal Reserve right now is at 4.75 on the base Fed funds rate. And then there's a spread above that in order to make these loans. And so right now with the Fed at 4.75%, the loan on average of, let's say, the 4 private loan funds that I'm using for clients is about 10%. So if the Fed were to lower the Fed funds rate by 1%, that would go down to 9, okay? And so I find these to be a really interesting opportunity because these loans are the first loans to get paid back in the capital structure. And so if something were to go wrong with these businesses, they're first in order in any type of bankruptcy procedure. However, the current loan to value ratio is 40%. So essentially, if this private equity firm thinks this business is worth $100 million, that value really has to go down to $40 million to start to think about losses in those loan funds. So I find that to be something that has resonated with the pest control owners because they're beginning to understand more about the private equity industry. And this is a way that these private equity funds are financing the transactions that are occurring. So that's one thing that we've been doing in a great way to replace income. And so we've been having some discussions about that this week.
So you're typically replacing income in a combination of private credit funds, the equity market?
A bit in the equity market. I mean, the equity market, there's some disadvantages and there's some advantages, okay? So the yield, the overall dividend yield, let's say, of the global stock market is around 2%. So, if you're investing a substantial amount of money in the equity market, you're not getting much current income in return. However, over a longer period of time, if you are achieving good returns in the stock market, the advantage of that is that when you do sell stocks to fund your lifestyle, it's capital gains tax rates, which is much lower than ordinary tax rates from, let's say, some of the private loan funds. The other thing we're doing, though, is that we're deploying a number of investment-related strategies that target market-beating returns, but can significantly reduce the ordinary income component for the pest control owners after they sell, which is, a substantial benefit particularly when you think about owners who typically don't pay a lot of cash taxes as they continue to reinvest in the business. They essentially are shielded from that given the high expenses. So once they sell, having a high tax burden due to all this investment income that we're generating is something that no one wants, right?
I mean, right now in the U.S., like, what would the tax rate be on investment income from these private credit funds?
Yeah, so the top marginal rate is 37%. So if someone lives in, Arizona, there's an incremental 2.5%. If someone's in Florida, it's obviously zero. California, it's 13.3%. So, you're paying oftentimes over 40% incremental on that investment income. Okay, so it's important to get that down.
I mean, is there any way to offset that?
There is. We're deploying investment-related tools in order to reduce that ordinary income and while still generate a return. And a lot of those things are proprietary and kind of like our own intellectual property. So I typically don't get into that, but they have proven to be very effective to not only reduce the taxes, but also generate a return.
So if I lived in the States and let's say I made $1 million out of these private credit funds, like, what sort of offsetting would you potentially be able to do?
So if someone had $1 million in ordinary income and we were to divert, let's say, $4 million into these other investment related strategies that lower the ordinary income tax burden, with $4 million, we could lower ordinary income by about $1 million. So it's a substantial benefit and extremely capital efficient. So if you think about that for a second, if you put $4 million in these investment related tax strategies and you're able to reduce ordinary income by $1 million, assuming a 40% tax rate, that's $400,000 of cash tax savings every year. So $400,000 of cash tax savings on a $4 million investment, you're getting a double-digit return, 10%, just from the tax component before you consider potentially earning, anywhere from a 7 to 10% return on the actual investments that are generating those tax savings.
Well, what happens if I'm doing $1 million in ordinary income in my business right now? I'm not in the credit fund. I'm not worried about equities. I make $1 million in my business. Are you still able to help me offset those taxes?
I'm able to do a bit, but the more money someone has that is able to deploy in these strategies, the more I'm able to bend that effective tax rate. And, the problem, and I think it's a good problem to have, is that most PCOs are continuing to invest in their business at high rates of return in their business, which I endorse and I'm all for. And so they're not keeping back a lot of funds that you can then deploy in some of these tax strategies. Okay. One other question that I've been getting here at Pest World is that, how does Matt Rogers always find the best coffee in a given city and the best restaurants? I mean, you travel with Matt a lot.
I can't answer that question. I can get Matt Rogers up here.
I mean, how much time does he spend doing that?
We ought to get Mr. Brady here talk about his, huh?
So we can talk about his honeymoon?
He should talk about his honeymoon PR. Why don't you step up here? We got a few minutes. We're about to close shop here. Come on up. Yeah.
Make a lot of money.
Get over here.
Here. Give him the mic.
This is a terrible idea.
So
I was more curious. I was going to ask you.
we like to make a lot of bad decisions, and so maybe this is one of them. We'll see. Ask us.
Mike, I was asking more. I was going to ask more about with what you guys were just talking about with the bigger guys pulling in. I think that was why Rollins acquired Fox. I think they were looking for the door-to-door capabilities that they used to have. I mean, my family sold with Eclipse back in the early 2000s for Fork, and I think they're trying to go back to some of their heritage. But with that, is that going to change for people like myself where we should be in 5 or 10 years? Is that going to change our exit strategy? Is the PE are they going to be as prolific as they've been, or what are we going to see? Short term, nothing's really changing until it does suddenly. But what is that going to mean in 5, 10 years for some of us that are younger guys that aren't quite ready to exit, but within 5 or 10 years, if the market stays this way, we could be.
That wasn't about his honeymoon.
You what?
That wasn't about his honeymoon in Puerto
No,
Rico.
we'll get to the honeymoon. Yeah, I mean, it's a good question because here's the decision tree looks something like this, right? You're trying to grow cash flow. You got a variety of ways to do it. Yeah, online marketing, door-to-door sales, acquisitions, all sorts of stuff. So the problem is acquisitions have gotten so damn expensive now. It's actually prompted guys to look at door-to-door in a way that they had never looked at historically. And I actually believe that 15 years ago, 10, 15 years ago, the door-to-door summer sales, we called it back then, it was a shit show. Like, it was just, none of these...
It was a party. It was a party.
It was a party. But none of these guys really did a great job, if we're honest with ourselves. I mean, they just sold accounts. They didn't really service it. The goal, and it was never really to build a business. It was always like, hey, I'm going to do this for a few years. I'm going to flip it to Terminix, right? But there's a lot of guys in the industry who've actually gotten wise and said, look, I can build a long-term sustainable income-producing asset. I know how to sell on the doors. I'm going to use that, and I'm going to have a good business, kind of like you guys, right?
Exactly
Right.
what we've done. It's been excellent.
You have not intended to flip it, so you guys are actually building real businesses. You guys have now begun to, in recent years, get rewarded for that, like, because the guys who are doing it right, and I am without a doubt, I can look. There's a spectrum. It's like, the Mexicans on the spectrum somewhere. We don't know where it is. Every door-to-door company is on the spectrum. Like, there's shit show dumpster fires, and then there's guys that, like you guys. You guys, remember I went through your P&L? I was shocked and astounded, and I want to talk to you about that in a minute. But there are companies that are doing a great job, you guys being one of them. Those are actually assets worth buying. And so the question now, I think, that all of the big players are asking themselves is, these other guys are doing it. Why can't we do it? And why haven't we done it? Well, we haven't done it because we thought it sucked, but it actually doesn't suck because some people are showing us that it's actually not bad.
I've been impressed by the door-to-door folks that I've talked to, how they have a strict measurement on the customer economic variables, right? So they're very tightly managing the variables that drive the net present value of a particular
door-to-door
customer.
guys?
Yes.
Some of them are.
Yes,
some of them are idiots.
Some, like you said, the spectrum.
Yeah, I mean, there's a spectrum. So we're going to call this show the spectrum. So I think the implications for guys like you is, as acquisitions get more expensive, bigger companies start to say, maybe let's use door-to-door. Now, the reality is, how are they going to pull this off? And here's what I mean by that. If you were a technician for Orkin and you were making, I don't know what they make, 60 grand a year, and then you had some hothead, blonde-headed dude that comes from Utah, and he's on the doors, and he's like, yo, my dick's so big, I sell so many accounts. I don't know if LDS dudes say that, but they might think it. He's making $300K a year. That creates a lot of problems, I think, for some of the big companies. So that's a problem. Well, how do you deal with that? You do what I talked about. You invest. You either greenfield a door-to-door business that you own a minority interest in, or you invest in one. Now it's kind of separate. You're selling accounts for Orkin or Terminix or what have you. So I think there's a lot of details to figure out there. I think they're going to do it. I think we're going to see it. With regard to Fox, they're doing some door-to-door, not a whole lot. Rollins doesn't have the capabilities now. They will. Within the next year, they'll have the capabilities to do it. Rentokil will as well. Eric Reimiller, who is the COO of Rentokil North America. Great guy. Brilliant. He was a ground pounder. The guy would just grind. He left Rentokil 2 weeks ago. He was the guy who, when we took the Borg's businesses to market, your boys Fat Jared and Fat Jake,
Now skinny.
now skinny. Actually,
They were here this
Skinny
week.
Jake,
the
for
Mexicans
sure.
said is a state of mind. So when we took those businesses to market, we did a full process. The private equity guys, the whole 9 yards. Eric Reimiller said, Paul, I like these guys. I like these businesses. I'm not interested in door-to-door. It's been real. I'm out of here. And that's been his position for a long time. And he's conservative, and I appreciate that about him. He's gone now. So it's a new era. Like, the new guys are in town, and they're looking around, and they've got to get growth. And then, got Tryon on the board at Rentokil saying, got to move this thing along. So it'll be interesting. Like, I'm not sitting up here on stage saying Rent-A-Kill will do this. I'm just saying, like, if there was ever a time to do this, like, that we're in a new era. For me, the jury's kind of out on how it'll impact guys like you. I don't think you guys are under an immediate threat, but like, it's one of those things where if that happens, like, things could change, and it's pretty uncertain. So it's hard to determine how that'll. I have to give this has been a new thesis that I've kind of thought about in recent weeks, and then some of the meetings that I've had here with some of the bigger players have. Yeah.
Well, and I've been thinking about that with where we're located. There's been a lot of M&A activity, like everywhere, but also there's a lot of new door-to-door entrants on the smaller scale, but also all of the bigger guys are now opening branches in our region.
So you guys have how did you guys build your business? What was your MO? Like, you and your brother have a great business.
So we sold door-to-door for a long time. It's been our family genes. I mean, my dad did it for a summer. My second oldest brother did it back in the early 2000s. We jumped in. Well, my mom told me when I was younger, it's like, hey, go to college, go sell pest control with your brother. Why would you not do that? You're stupid if you don't. Okay. So we did that. We worked with them for a while, and then we were looking to open a new branch, and they told us, hey, you guys are dumb if you open a branch with us. You should just go start your own.
And who told you were dumb?
Jared and Kyle.
Got Jared?
Yeah.
All right.
Yeah, so we'd worked for them for, Josh and I, we'd run teams for them in Chicago and Virginia, and they were great, awesome to work with, and we really were involved with not just the sales side of it. That's what I loved about it, is we were in their technician meetings, we were in their operations, and we saw, like, you saw their numbers, you saw Point, it was a good company. And so when everyone's like, door-to-door sucks, we're just like, it's just marketing.
Does it?
Like, we thought it was a real pest control company, so I didn't know what they were talking about. So when we left just to start our own company, we went where my brother's wife was from, and we just happened into a great market up in the Northeast. And now everyone is coming out there as well. And it just, we started, we brought a couple guys, we just knocked doors. I would sell it, Josh would service it. We did that for 2 years, then COVID hit, and nothing went. It was super illegal in Massachusetts and those areas to talk to people. So we kind of slowed down, and then we brought back after COVID the door-to-door teams, and it's just been great.
But you guys are sales guys, so how did you learn how to run that business and build that business and organize that business?
Well, so like I said, the last summer, we worked in the training meetings. We would meet with their branch manager on their weekly training meetings that has nothing to do with sales when we lived. I mean, heck, Josh lived in Chicago.
Yeah.
He lived in Jared's office for 2 months after we finished this one summer, and he stayed till October, taking, cloth baths in their bathroom.
With Jared?
I don't think Jared was there, but I'm sure he'd lend a hand if he needed it.
Okay, yes, he would. He's a good fellow.
Yeah, but no, we slept in their boardroom for 2 months because we were broke kids trying to start a company, and we just air mattressed and learned and watched everything from service to a little bit of commercial to all the things that the typical door-to-door guy doesn't see, because all they do is just cheerlead for sales.
And weren't you like George Costanza, and you did the opposite of everything Pat told you to do? Is that true?
Most of it.
Yeah.
We're typically like, okay, what do we see? Let's not do that. Yeah. And then what do we think makes the easiest, most sense? And then it works.
Yeah.
So, I mean, it's not hard to do it the right way, I found. People overcomplicate these things. It's like, get a customer in the door, do everything you can to cancel them in the first 30 days. If they stick, they're a good customer, keep them forever. Like, that's our motto. Like, make sure that people want to be there that are there. If they don't want to be there, just let them out. Who cares? Don't let the sales guys dictate it. Tell them, hey, sorry, we don't service that street. You do, we're not paying you on that. Sorry. I don't care that you sold a fat contract there. Thank you, I'll take it. You're not getting paid on it. They don't sell on that street anymore.
You were recently down in Puerto Rico. When was that? When did I see you down there?
It was August.
August.
Just got married August 2nd.
So you picked the worst time ever to go to Puerto Rico.
No, I picked the best time. You know what's the best way to spend a honeymoon? Stuck in a hotel room because Ernesto is blowing through the island, so you can't go anywhere.
All right.
Being stuck in a resort room isn't the worst way to spend a honeymoon.
Yeah, I guess I didn't think
Touche.
about it that way.
Touche.
You couldn't go. You were down there for like 10 days. Couldn't go anywhere.
Yeah, we were there a little over 2 weeks, and it was beautiful, and then it was awful, and then it was beautiful again once the storm passed. We didn't get to go to the Vieques. We almost got to go to the Vieques. We turned down the Mexican. He offered to let us.
Wasn't he gonna boat run you over there?
He's going to boat run us over, and then we were going to stay at his place. And I politely declined that offer.
The marriage hadn't melded yet. You were concerned.
Yeah.
It didn't set yet. You wanted to make sure.
I say she's still not able to stay. She doesn't have a green card yet. I want to make sure that we lock this down before she actually stays.
What was her opinion of the Mexican?
I mean, does anyone have a different opinion of the Mexican?
No, but I like to hear it.
She's like, he's crazy. Is this what you do? It's like, well, no, this is what the Mexican does. What we do is, well, nothing like this. No one is like the Mexican.
No one, indeed.
So,
Okay.
yeah, it's been great working with you guys, listening to what you guys have to say. It's like I said, it's not hard to do the right thing. You get to come down, visit Puerto Rico, get some good advice, talk to people that know what they're talking about, see. I mean, I'm no Nostradamus, so we talk to you guys where we see a little bit what's coming down the pipeline, and then we make adjustments and pivots accordingly. And like we're at least $1 million richer because of what you guys have said. Like,
Awesome.
so, and that's just right now.
I'm hoping you're more than $1 million richer.
Oh, I'm just saying where we're at right now, 6 years in. Like we're at least $1 million bigger and further and profitable.
Give me one example of something that you've used that made you richer. Like,
We switched to monthly billing.
okay.
We were selling quarterly services, selling at a good price. We came in on the shoulders of these other guys, and so we were never lowballing, but we came in at market rates or above market rates. We shopped around, but then talking to you guys and some of the people, your clients, are like, well, if you're not doing monthly billing, you're doing it wrong. We switched to monthly billing, 40% increase on our rates, no cancellation rate. Our monthly revenue is now steady and consistent and predictable.
I love you guys as a case study because I remember at Hawaii last year, I hadn't really gotten to know you yet and looked at your numbers and had any sort of serious discussions for you about planning for the future. But I remember you came to me and you're just like, dude, we were just sales guys. We just turned the buzz on. We listened to it. We were just like, fuck it, let's do it. And you guys just did it. And your business is just like, it's amazing. It really is.
Yeah, and we try to keep, I mean, as stupid as it sounds, we try to keep our growth manageable. We don't want to do the 200, 300, 400% growth year over year. It's expensive. And that's when you let crap in through the door. So we keep it 50% or close to that year over year growth. And we keep profit margins high. And if it's not profitable growth, then we don't do it. So we turn away all the sexy ancillary services that are chunky, as you say, because it's a ton of money to the bottom, but it's not recurring. We just don't do it.
I would argue live on the air that you guys have the profile of your business, the fundamentals, is probably the best in New England. Now, obviously not on size. What are you guys, like 4 or 5 million now?
Yeah, about 4.5.
I'm not saying the biggest, but I'm saying like the cash flow, the level of risk, the growth rates.
Don't tell my wife.
I would say it would be my number one pick for New England, your business, what you guys have done. Don't fuck it up.
I just let Josh run the operations, and it runs well.
Where is Josh?
Oh,
there he is. Looks different. Is his hair grown out?
I don't know. He's got the Jufro. I don't know where it came from.
Got it. I can see that.
No, he runs.
Get him up here. Let's get that. Let's get that on camera.
I'd say he runs all operations, and anything that has to be correct, he does it.
This is the last show at Pest World, which has turned into somewhat of a variety show, right?
It has.
Yeah,
it has.
If you go ahead.
Well, and that's where your value comes from.
Yeah.
I mean, who else do I talk to that isn't just a giant guy that's saying how great they are, or a small guy that thinks they're better than they are?
Sit down, Josh. So give it to us.
Just you can talk into it. It's a mic.
Oh, it's turned on.
It's good to see you, man. I haven't seen you.
Good to see you guys too.
Yeah.
Good to be up here. Thank you for having us.
Your hair's different for sure.
Oh, absolutely. I'm
Last
the
day,
guy who
no
just
comb
gets-
left.
Yeah. stuck in the office, forget to go get a haircut. That's why he's the face of the company. I just keep me in the back office.
Weren't expecting to be up here either, you know.
So people will ask us all the time, like, hey, what's your secret sauce? They'll, especially like we run through fraction. So Patrick does our numbers. So Patrick will ask us, well, Cameron will ask us in our monthly meeting as we're going through it. He's like, okay, cool. And it's just the most casual, quick meeting because he's like, yeah, you're hitting all the goals. You're exceeding all the goals. Why do we even have the goals? You guys are never even close to them. And we're just like, well, I don't know, because you're supposed to do this, right? And he's like, well, what's your secret sauce? And we're just like, we don't know. Like, we don't. And I hate to just plead ignorance, but we just do pest control. We just do it right, I guess. We don't know what the secret sauce is. And I'm always baffled when people tell me what you're saying, like, oh, you guys' numbers are so different from everyone else's in these areas, and I don't know how.
I think my winter project, my intellectual project this winter is, I'm going to do a diagnostic. I'm going to figure out what it is.
And say
I'm going to delve in and figure out what you guys are doing different.
One of the things that I would think and say has been most helpful for us is we're new in the industry. We're new to our business and stuff. We don't have a whole lot of our own ideas. And we've been very good at, listening to you and your guests and all that. And you asked how did you learn the pesticide stuff? Just ask people and they'll tell you. We have the department heads regularly come in and help us out and they'll tell you. So just really leveraging those relationships has probably been the best. So we don't have to reinvent things. This pest control business isn't new, and the business side of things, we rely on you guys.
Yeah.
As I say, I think focusing on the fundamentals, which is stupid, but okay, route density. Our average technician is driving 20 miles or less a day, doing over $2,000 a day per tech. Mm-hmm. We're preloading them up with just 12 stops every day. We pay production, so we can control all of our numbers really well. We know what it is. We buy in bulk annually when they're on sale, so we buy drums. Like, we don't do anything fancy. We just do the right things. And like I said, if we've got a guy driving more than 50 miles a day, we look at that and be like, okay, why are we not on these same two streets? We've got enough customers. How do we, and with the monthly billing.
Dude, you remind me so much of Jared. You're like a Jared prodigy. Just like the way you talk, the things that you say, you remind me of him.
Well, cool. If we could sell for Jared, that's cool. That's the goal. But I mean, we look at it and it's just like, just keep your customers, keep them happy, and keep it tight. And so, switching to monthly billing, we'll push people over a month just to get hyper density route. And then now we're looking for a few other things. We're going to be putting in lawn signs this year. And it's so funny because I was looking at this map dots and I'm like, we're just going to drive and you're just going to see anchor lawn signs on one street if we do it all in the same day.
You should talk to Matt Brill and Ryan Klaterbaugh. Those guys are the masters. He was a guest on the show early on. I'll introduce you to him.
That's why we're doing the lawn signs.
Master of, because he's the master of lawn signs. Yeah.
Yep.
I mean, he had this was a business that did less than 10 million in revenue, and we were selling it. Like, the Orc and crew thought it was like $100 million business.
Because he put lawn signs in their
all
their
the
neighborhood.
executives I mean, he really, so lawn signs.
Yeah. And those are the types of things we get from your show and from, conversations. I was talking to Dylan earlier and I was like, hey, you were talking with, I think it was Rob Greer, and he was talking about Fluke. And I'm like, you guys mentioned so many books. Like I just finished Thinking Fast and Slow. I finished, I can't remember the other books now. Yeah. But I was talking to Dylan, I'm like, hey, you guys mentioned so many books, and I've got stacks of them that we're going through in the office. Like, can you just run AI through all of the transcripts of all of the Buzz episodes, all your Potomac TV, and just give me the repository of all the books so that I can catch up on all the things? Because, I mean, you'll have a guy that'll mention 4 books at a time. I'm like, okay, I don't have any kids yet, but I don't have that much time.
Right.
Then use AI to summarize the books.
Yeah.
Well, guys, it was great having you up here.
I didn't say it's certainly unplanned. Thank you.
Yeah, it was unplanned.
Maybe for pulling this up.
Thanks for coming up, guys.
Time for me to head to the airport, but that's it. You guys are done.
Cool.
Thank you.
See you guys.